Welcome back, my friends. Big institutional real estate investors are starting to get some heat from the U.S. Securities and Exchange Commission, SEC. The SEC is reaching out to Blackstone and Starwood, two of the largest institutional real estate investors. Both Blackstone and Starwood have now limited investors' withdrawals from their funds. In fact, investors are pulling their money out of these big real estate funds at a fast pace. The SEC is now asking for details about these decisions. If you have been following this channel, you already know that the U.S. housing market is in sharp decline. As you might expect in a time of popping asset bubbles, house flippers are getting burned. Fed Chairman Jerome Powell has finally admitted what all of us have known for a long time. Specifically, U.S. home prices are in the midst of a major correction or even a collapse. Institutional home buyers bought houses over the past few years as if they were going out of style. That included iBuyers like Zillow, Redfin, Opendoor, and OfferPad. It also included small-time investors and home flippers. But now, the tide has turned, mostly due to quickly rising interest rates. General sentiment about house prices has been thrown into reverse. And all of these buyers who rushed in are now exiting just as fast. The U.S. housing market is seeming like a speculative bubble once again. And house prices in the United States are in decline. And there are probably a number of investors in the right that think real estate prices will further deteriorate. So, what does this mean for Blackstone? What does it mean for REITs? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. The Blackstone and Starwood real estate investment funds are what are known as REITs. What is a REIT? For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. It could be structured as a mutual fund, almost like a stock mutual fund. Or, it could be set up as an exchange-traded fund, or ETF. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission. The focus is their recent moves to limit the ability of individual investors to take their money out of the company's real estate investment trusts, according to reports that are surfacing. The real estate funds have recently seen a surge in withdrawal requests, amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions after monthly and quarterly withdrawal limits were reached. Investors in and outside of the funds took notice, as has, apparently, the SEC. The regulatory agency reached out to both Blackstone and Starwood. The agency was looking into how the firms served redemptions to their clients, and if any affiliates of the two companies sold their shares before the clients, according to one of the sources. The inquiries are not indications that either firm is under investigation or committed any wrongdoing, the report said. Representatives for Blackstone and the SEC declined to comment to Insider. A spokesperson for Starwood did not return requests for comment on Friday. Individual investors deal a blow to Blackstone's stock. Blackstone launched the Blackstone Real Estate Income Trust in 2017. Blackstone's fund is called BREIT, which stands for Blackstone Real Estate Investment Trust. The fund is designed to cater to rich individuals. And these rich investors are always looking for better investments. High net worth investors were looking for better returns in what was then a near zero interest rate world. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone REIT amassed $68 billion in assets. Then, in 2021, Blackstone launched a fund called BCRED, which stands for Blackstone Private Credit Fund. The BCRED fund was designed to replicate the BREIT fund for private credit investors. But what a difference a year makes. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. I am concerned over the fund's growth, said Bill Katz, a research analyst at Credit Suisse in a report to clients. Katz followed up his statement and downgraded the stock, slapped the equivalent of a sell rating on it. Shares in Blackstone shares are down 21% in the past month. That compares to a 3% decline in the benchmark S&P 500 index. But most REITs invest in commercial real estate. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private REIT. President and Chief Operating Officer John Gray defended the positioning and structure. Gray noted that investors knew BREIT had limits on redemptions. BREIT stands for Blackstone Real Estate Income Trust. And, as I am sure you know by now in this video, BREIT is not structured as an exchange-traded fund. So, investors in the fund cannot just sell their shares anytime the stock market is open. Instead, they need to contact Blackstone and request a redemption of all or a portion of their shares. Even if a fund is not tradable on the stock market, it is normally still divided into shares. And real estate is not a highly liquid investment. So, the fund needs to make some sort of judgment as to how much cash it should make available for redemptions. And, in this case, investors in the fund want to take out more money than Blackstone can make. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year-to-date. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. New subscriptions in the fund experienced a major drop-off. Subscriptions fell to less than $500 million. That compares to $880 million in September. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. Meanwhile, Redfin shut down its institutional home buying. And it is selling off its portfolio of homes as quickly as possible. Redfin CEO Glenn Kelman says that the company is cutting prices by 5% every week that a home sits on the market. Astonishingly, Opendoor reported having more than 2,000 houses in the purchase process at the end of Q3. Mortgage rates have doubled since January. That has crushed buyer demand and cratered values in real estate investors' favorite cities: Phoenix, Las Vegas, Jacksonville. It is a stunning reversal of fortune for flippers. They are now stuck with homes to sell and with loans to pay. Home flipping reached a fever pitch at the start of the year. 10% of all real estate transactions were flips. But the home flipping rate has been falling since Q2 and economic conditions are weakening. Demand has cooled spectacularly fast in Sunbelt cities: Phoenix, Jacksonville, and Atlanta. Pandemic-era boomtowns where affordability has been strained: Boise, Salt Lake City, Denver, Las Vegas, and even Austin. Institutional iBuyers Redfin and Opendoor are also getting burned like traditional flippers, only on a larger scale. 42% of the homes that Opendoor sold in August sold for less than what it paid for them. Opendoor lost money on 76% of its deals in Phoenix. Betting on rising U.S. real estate prices was a winning strategy for at least a decade. But the markets have reversed course and houses are attracting lowball offers. But prices seem to be declining every week as sellers get more desperate and buyers back away. Home builder sentiment is in a record collapse. What appeared to be a slow and mild downturn has picked up steam every month since then. New home sales are down almost 30% from a year ago. And existing home sales are down 20% from a year ago. Sensing that home prices are in free fall, home buyers are now pulling back from the market. The United States economy now teeters on the brink of recession. Housing prices are falling in many U.S. cities. But how far will they go? Experts predict that house prices could fall by up to 25% over the next few months. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.